Good morning, ladies and gentlemen. My name is Michael Locke. I am the Group Chief Investment Officer and co-head of Asset Management at UBP. It is indeed a great pleasure to welcome you for this UBP web seminar, Investment Outlook 2020 Reset. During this event, you will hear from our Chief Economist, Patrice Gautry, who will present us with the macroeconomic outlook, followed by the FX outlook presented by Peter Kinsella, our Global Head of Forex Strategy. The final presentation is from Norman Villamain, our CIO Wealth Management. Norman, and its important parts, will highlight what we said for this year and see how it looks now. I would like to invite our Chief Economist, Patrice Gautry, to give you the macroeconomic outlook.
Thank you, Michael. Just to remind that your questions are more than welcome, and you can send an email to investment@ubp.ch. This is the email box, or you can click on the box for the Q&A. Okay. So if I just go to the next slide, just presenting the views regarding the current economic environment, you see that, of course, we have seen a recovery process, a recovery coming from the industrial sector, and also a recovery with better figures coming from the consumer side. If we look at hard data and also COVID cases numbers in China and Germany, these two countries seem the best positioned, in fact, to quickly recover. For the other countries, namely the US and UK, we're just experiencing the end of the lockdown, and we have still some concerns in terms of COVID cases in the US. For emerging countries as a whole, I would say that Latin America is a concern at this point of time in terms of COVID cases and also deteriorating numbers in terms of economic activity, but the situation is improving in Asia as a whole. What does this mean in terms of economic scenario? This is the next slide. In the next slide, you see that we do expect, I would say, more constructive and positive number for the second part of this year after very depressed levels of growth and sharp recession in the first and second quarter. But you also see that what we are expecting is a huge difference in terms of synchronized recovery. This is not a synchronized recovery, huge differences between emerging countries and developed countries. Asia and China should lead the recovery process in the third quarter. We do expect China to go back to positive territory in the third quarter, while we have to expect probably for the fourth quarter to see, I would say, more probable positive numbers coming from developed countries. So all in all, this is not a synchronized recovery, and there are huge differences across countries and also across sectors. Of course, at this point of time, uncertainties remains high, not only related to the COVID cases, but also to this fragile recovery across sectors and countries. If ever we have to see a second wave of infections or to go back to a global lockdown, which is not the main scenario at this point of time, of course, we will have to consider more negative figures and a sharper recession for this year. But for next year, and the global scenario and the most probable scenario, we do expect a significant recovery globally, close to 5%. But of course, before considering this recovery, we have to have in mind two important factors participating to the full recovery. This is on the next slide, the subject concerning investment and also the employment. Investment, it is true that the corporate investment firms will not probably participate directly to the rebound on investment. Why? Because there are still tensions in the trade environment. And of course, the firms will pay more attention strengthening their balance sheet after the high level of debt they have put in place during the lockdown. This is why the public investment should play a large role at the beginning of the recovery. And we have seen a lot of governments launching new plans in which infrastructure should play a large role, and also research and development. The challenge is, of course, for public investment to restore and to comfort the nascent recovery, but after to boost growth and also productivity. The second quick question is related to employment. We have seen a strong rise in unemployment rates in all the countries. And the key question for the third quarter is how many people will be able to go back to work rapidly and to go back to a full employment. We will have probably to wait for next year before seeing significantly lower level of unemployment rates. That's to say, we will probably end this year with still elevated, not at record high, but still elevated unemployment figures. But these are cyclical sectors. Just if we consider what has really changed structurally in the global economy after the lockdown, the answer is on the next slide. And we have to consider two important factors. The first one is the ensuring of industrial activity. And after the second one is that governments have established and named strategic sectors. The first one, ensuring industrial activity. The process has begun with the trade tensions 2 years ago. Because, of course, as you see on the charts, the main part of US imports are coming from not only China, but also Asian regions as well. So the process has begun 2 years ago. And of course, we discovered during the lockdown period that the supply chain was very fragile and depending, in fact, on the openness of the different countries. So this is why the criteria of re-ensuring industrial activity is not only cost, is not only trade tensions, but now is to build a more resilient chain supply. The second important factor that structurally changed the global economy after post-lockdown, but after post-globalization process was in fact now that governments and states are identifying strategic sectors. Of course, these concern the pharma sector, but not only. US and China are focusing on the IT sectors, and we see that Europe has put a lot of money now on green investment. So post-lockdown and post-globalized, global economy will definitely structurally change. What are the implications regarding inflation? This is the next slide. We have seen a lot of pressure, upside and downside pressure coming on prices. It's true that the commodity prices and the oil prices have played a large role as a deflationary factor to the latest headline prices. You see on the graph at the top that energy prices are traditionally a high level of volatility and generate a high level of volatility and up and down in headline prices. And the opposite way, food prices have played a large role also on the rise during the lockdown period. Outside energy and food prices, we will see that core inflation was at the beginning quite resilient, but we do expect some slowdown, significant slowdown in the core inflation as it's illustrated on the graph at the bottom. It shows that structural shift in the demand will generate a high level of demand for health, services and services to consumers, and also in rents and housing, that should generate in the future a higher level of demand and upside pressure probably in these related sectors in terms of prices. What's the situation in economic policy and the legacy, in fact, of the post-lockdown period? This is the next slide, illustrated by the situation regarding the budgetary deficit. It's obvious that all OECD countries will now face a higher level of budgetary deficit, resulting for the emerging measures that have been taking place, but also a second wave of recovery and support coming to comfort the nascent recovery. So all OECD countries will have to face more than 10% of fiscal deficit to GDP, and probably will have to live next year with still a high level of the budgetary deficit. This is the reason why, not to be too naive, I would say that after the recovery in 2022, of course, we will have probably to consider a higher level of taxes, direct or indirect taxes, related to this high level of public deficit. The same situation for public debt. All the OECD governments, and this is the legacy of the lockdown and the legacy of the crisis, all the OECD governments and states will face now more than 100% of GDP, public debt to GDP ratio. And of course, this is the burden of the next growth cycle and the reason why we should boost productivity and potential growth for the coming years. What's the situation for monetary policy? And we will illustrate that on the next slide. It seems that at this period of time, now the central banks are preferring quantitative easing, that is, say, direct purchases on bond market and credit market, rather than managing the interest rates, which are already low or even slightly negative. And of course, inflation targeting is a remote tool because inflation is so low that is not active. So quantitative easing and purchases, direct purchases on assets will be probably the preferred monetary tools for the years to come. The results will be ballooning central banks' balance sheets, as illustrated on the bottom chart. You see that we have expanded a lot, and they will continue to expand a lot, the balance sheets of the central banks. This is a support to direct activity and also an indirect support to financial markets. Central banks will probably remain very active in these quantitative easing process. That is to say, even if after the recovery period of time, we are not expecting a tightening, a significant tightening, and central banks will probably remain active in bond and credit market. To conclude, and this is the next slide, we are slightly constructive, I would say, on the current recovery, expecting a gradual recovery for the second part of this year, but be aware, this is a desynchronized recovery across countries and sectors. And even if we have a positive scenario for next year, we are aware that investment and employment could lag in this process. And the structural changes are still active, changing the post-global economy, post-lockdown, post-globalization. They are important factors. And we have to live with a large public debt and, of course, more and more active central banks, which come closer and closer to monetary financing. Thank you for your attention. I invite Peter Kinsella, Head of FX Strategy, to present UBP views.
Good morning. Thank you, Patrice, and good morning to all of our clients. I'm very delighted to see you all here today. So today I'm going to talk about the FX outlook, and I will bring you to the next slide where we can go through and look at what's happening. So our key calls for the remainder of the year are that we think the dollar is going to weaken. We think that the dollar has, we believe that the dollar has likely peaked. We anticipate that we are seeing the end of the dollar bull market. The dollar has lost its carry advantage. It no longer illustrates high carry in an absolute or a relative sense. Likewise, we think that dollar valuations are at multi-decade highs, and we think this will not last. The dollar is likely to weaken as the global economic recovery gathers pace. We anticipate that safe haven currencies will continue to retain a strong underlying bid. Gold will continue to benefit from global monetary easing and a negative real interest rate profile around the world, both in emerging markets and in developed markets. The Swiss franc is likely to continue to benefit from strong capital inflows and a robust current account surplus. The Japanese yen will also gradually appreciate, reflecting the large decline in US and Japanese real yields. We believe that high beta G10 currencies will perform well, with the exception of sterling. Aussie dollar will likely continue its rise towards levels of 75, and dollar CAD will decline to levels of around 130, with downside risks due to commodity and interest rate spread developments. Is likely to struggle, reflecting the possibility of a no-deal Brexit and, of course, a lagged economic recovery. So let's talk about the dollar in more detail. Bring you to the following slide. The next slide, which basically shows how the dollar has lost its interest rate advantage. On the following slide, what we can see is that the chart on the left-hand side is showing that during periods of economic recovery following large recessions, we see that the dollar tends to weaken. And the reason for this, of course, is the reduced interest rate profile. But additionally, it is because investors no longer need dollar-denominated safe haven assets during economic recoveries. At the moment, we're in the middle, obviously, of the pandemic recession, a so-called pandecession, if you will. And likewise, what we're seeing at the moment is the dollar beginning to weaken as the global economy is starting to improve. Anecdotally, what we see is that when we're getting better data releases, as with yesterday's global PMI data, and particularly in European PMI data, the dollar is tending to weaken. The chart on the right-hand side shows the euro-dollar 1-month forward points. And what we can see is that the dollar's sort of interest rate advantage or forward premium has basically collapsed, reflecting the large decline in US Federal Reserve interest rates. The long and short of it is that the dollar is now cheaper to short. Into the following slide, what we can see is very poor monetary dynamics in the United States. US real interest rates are going to be negative and maintain a negative real profile for the coming years. Additionally, the pace of US M2 growth, broad money growth in the United States, has really increased substantially, and this is going to continue to weaken the dollar in our view. Bringing you to the following slide, we can have a look at sort of the underlying fundamentals in euro dollar. The Eurozone still illustrates an enormous current account surplus in the region of around 3% of its GDP, or just under $400 billion. The US illustrates a huge current account deficit in excess of around $500 billion. So those fundamentals are still very, very supportive for the Eurozone, and indeed will manifest as investors begin to repatriate capital. Bringing you to the following slide, we'll then talk about the valuations. What we can see, the euro remains very, very undervalued in both nominal and real terms. The chart on the left-hand side illustrates how euro dollar trades in relation to the euro trade weighted index. Normal sort of correlations would anticipate that euro dollar should be trading at levels in excess of 120. And we think over the coming sort of 18 months, that's really where euro dollar is going to go. The chart on the right-hand side illustrates the valuation differential. The dollar, as you can see, is trading at very elevated levels in real effective exchange rate terms, whilst the euro is trading at relatively low levels. So our view, core and very strong view, is that the euro will gradually appreciate against the dollar over the coming 18 months to levels of around 120 by the end of 2021. Bring you to the following slide. In our view, we think that sterling weakness is set to continue. Regular readers, and indeed most of our investors, will know that we've had a reasonably constructive view on sterling over the last 18 months. However, we've changed that view in recent weeks. The first reason is that the Bank of England is set to introduce negative deposit rates, possibly as early as August. This will be the first time a country with a current account deficit has introduced this policy, and we think this is a very risky strategy. Additionally, we have the ongoing EU-UK trade deal talks, which have achieved very little in terms of substantive progress. Although we do note a modest improvement in the tone of the negotiations in recent weeks, we still think that the chances of getting a trade deal are at best 50-50. Anecdotally, we also notice that sterling volatilities tend to increase coming to so-called political deadlines, and indeed we will have many of those over the coming months. Headline risks will remain elevated for sterling, and we think that risks are for sterling to decline to levels of around 120 against the dollar. Bringing you to the following slide, we can then discuss the outlook for the Swiss franc. Still very bullish on the franc. The franc benefits from a huge current account surplus of around 10% of GDP and from constant capital inflows from around the world. The Swiss National Bank has had to drastically increase its FX interventions in recent weeks and intervened to the tune of over 100 billion francs. Some idea of the strong underlying appreciation pressure for the franc. By the end of the year, we think that Euro Swiss can decline to levels around 1.02, and Dollar Swiss we think can decline to levels around 0.9. So indeed, continued Swiss franc appreciation is a core strong view. Bringing you to the following slide, when we're talking about gold. As many of you will know, we have a very, very bullish view on the yellow metal. This is a reflection of one, the negative real interest rate profile in the United States and indeed around the world, and of course the pace and scale of broad money growth in the United States itself. Our view is that fair value for gold is probably to be found at levels of around $2,100 per ounce. We also note that investors have largely missed the up move since March. Investor positioning is basically flat since that time. And that explains why dips in gold have been very shallow, and indeed it kind of is an indicative of very strong price action, which we believe will continue over the remainder of the year and next. The strong view is that gold will continue to outperform in the current situation, with upside risks if central banks engage in further unconventional policy measures. Bringing you to the following slide, we will then look at the commodity currency block. We've seen that dollar CAD was trading at levels of around 145 earlier this year and has subsequently declined to levels of around 135. Notably, PMI data around the world and indeed in China as well have shown a very decent improvement in manufacturing sentiment. The oil price likewise has also risen, which is highly supportive for the Canadian economy. The Canadian Central Bank is unlikely to ease policy aggressively over the coming months, so we think that the tail risk of aggressive Canadian dollar weakness is quite unlikely to manifest. Bottom line, we think the combination of broad dollar weakness and modest interest rate spread advances for the Canadian dollar, as well as commodity prices, will lead to dollar CAD trading to low levels of around 124. For Aussie dollar, again, the situation is quite constructive. We've seen that certainly swap spreads are moving in favor of the Aussie dollar. Additionally, Australia benefits from a large current account surplus for the first time in nearly 30 years. And of course, it will benefit from any resurgent commodity demand, particularly as Asia gets back to work. So we think that Aussie dollar can rise to levels of around 0.75 with risks firmly on the upside. Bringing you to the following slide, we'll talk about the Japanese yen. In our view, dollar yen is set to decline very slowly and gradually to levels of around 100. The development of US and Japanese real yield spreads indicates that fair value for dollar yen is to be found below 100. Japan also benefits from a very large current account surplus, which is highly supportive, of course, for the Japanese yen. So the bottom line is that dollar yen remains a sell at levels of around 108 with a view to moving to levels of around 100. And finally, we'll bring you to the next slide where we talk about the Chinese yuan. Previously, we'd anticipated that dollar renminbi would trade at slightly lower levels, reflecting both broad dollar weakness and also reflecting large capital inflows to benefit from the large or significant yield pickup, which was on offer from onshore Chinese government bonds. However, the rapid deterioration in US and Chinese relations, not just over the Hong Kong issue, but of course related to the onset of coronavirus, means in our view that these capital inflows are unlikely to manifest anytime soon. Consequently, we think that risks are basically on the upside, at least until the US presidential election in November of this year. Thank you very much indeed, and I'll now pass you on to Norman Villemin, our Chief CIO.
Thank you, Peter. And just to remind everybody who's on the line, if you're joining us by phone and you have questions, feel free to email your questions to investments@ubp.ch. Or if you're joining us via the webinar, you can type your questions into the chat box anytime during the presentation, and we will address those at the end during the Q&A session. So as we kick off, as Peter as well as Patrice have outlined, we are in a new environment as economies start to emerge from these lockdowns that we've seen around the world. For those of you who've been following our webinars as well as our podcasts since March, a lot of you will remember that we coined a term which we referred to as a doom loop. And this was the prospect that in particular, the coronavirus outbreak combined with the lockdowns was going to move through global economies and result in a credit shock that would result in a 2008-2009 style or even a Great Depression style result. But what we have seen is central banks in particular have established very good firewalls and responded very quickly over the past months to address this. As a result, from an investor's perspective, we have not only seen these markets rebound, but just because they've rebounded, one of the things we want to reiterate is that we do have a different environment and we require a different framework for addressing investment opportunities and risks in this environment. So if we move to the next slide, we'll share with you what we talked about really only 6 months ago to anticipate 2020. And interestingly, from a global economy perspective, this issue of transitioning to monetary fiscal was something that we're seeing right now in particular, triggered by the coronavirus. But in reality, this was something that was going to happen anyway, as we were approaching the end of the monetary tools and a need to go towards more fiscal reliance to continue growth. The reliance on geopolitical stress also grew. We continue to see that between US and China. And our focus on the risk management message through 2020 was going to be key. A lot of people will forget in January, valuations were extremely extended. really elevated only by Fed easing. But when we look at the individual markets, equities and fixed income, these were a place, obviously, in light of the coronavirus, that we were a bit more challenged. Equities, anytime until most recently, were underperforming, now increasingly catching up and closing that underperformance vis-a-vis bonds. The China story, where the coronavirus started, has remained reasonably resilient. And in the fixed income space, we were actually very well positioned for the interest rate volatility that we saw, both to the downside and more recently to the upside in government bond yields. And as Peter has highlighted, the volatility in the US dollar has manifested more towards the weak side as things stabilize. So on balance, though a challenging picture here in the first half of the year, this reliance on risk management and the agility within equity and fixed income have allowed us to navigate this environment very well. If we move to the next slide, as I mentioned, this transition, just because we've rebounded, equities are now positive for the year, it doesn't mean we're going back to the pre-coronavirus type of environment. What we do think has happened, as I think both Patrice and Peter have outlined, we do have a change in both the economic as well as the geopolitical order. And we think those changes are going to translate into changes in both consumer and corporate behavior going forward. As a result, what we're encouraging investors to do, and what we've done in portfolios for our clients, is to increasingly re-anchor these portfolios to this new environment. First, by focusing on what we focus on primarily at UBP, which is a strong risk management foundation, really re-anchoring the portfolios to this new risk scenario that we see going forward. And then on top of that, focusing on not only growth, but growth via the transformation of the economies going forward. How do we do that? If we move to the next slide, one of the things we'll realize, obviously, we saw volatility spiking in March and April. It's come down since then. But if we look back to the examples of, for example, 2008, 2009, one of the things that we think will be with us going forward are these what we call echoes of volatility as the economies have to digest the consequences of what we've just experienced. So you can see after the global financial crisis, almost immediately in the next few years, you've seen two volatility spikes, the flash crash and the Eurozone crisis. And those types of environments are something that we'll want to accommodate within our risk management framework, especially since interest rates around the world now are at or near zero. If we go to the next slide, why is that important? If we look back since the global financial crisis, you can see in 2008, 2009, you could have leaned heavily on risk-free bonds. Here we use US Treasuries to try and offset some of the declines that one experienced peak to trough in that crisis. As we've moved forward and markets have fallen, what you've started to see is much less responsiveness as yields are already quite low to these declines in markets, even if they're temporary. So one of the pivots we've made within portfolios is a shift from a reliance on these risk-free bonds in bond portfolios to increasingly what we like to call safe haven portfolios, really diversified portfolios, which rely on a number of different factors. I think interestingly, one of the key factors we're increasingly relying on are effectively implicit and explicit central bank guarantees and protection. And then we wrap around that positions, as Peter has highlighted, in safe haven currencies, gold, and more active strategies like options and absolute return strategies in portfolios to effectively replicate that cushion within portfolios to help preserve capital and preserve wealth during periods like we've just seen. On the following slide, we'll get into some of this in a bit more detail, and in particular, this idea of explicit and implicit central bank protection. So just to give you a sense, So why have markets rebounded so sharply? And in particular, why have credit markets rebounded so sharply? Everyone says, yes, the Fed is going to buy corporate credit. In reality, they haven't actually bought very much. But what they have done is really, since February, spent $3 trillion to buy treasury bonds and mortgage-backed securities. That liquidity is how they have supported markets and driven asset prices back up. To give you a sense of what they have in reserve, they're very kind. They've outlined these facilities that they've newly created. And roughly speaking, they have about $3 trillion in additional reserve in the event that we see another round of volatility or threats to these firewalls they've built over the course of the last few months. How does this play out in markets? On the next slide, you can see, in particular, on the left, you see in the US credit markets, these are US credit spreads, and effectively what the Fed is doing since March via their communication facilities, they're announcing and effectively walking spreads down. So first they started with the announcements of the facilities, spreads came in, they said, oh, we're not so comfortable, we'd like them to come in more. They expanded the facility to effectively high yield bonds. They came in some more, and then they said, okay, they're not coming in enough. They announced they're going to begin purchases of ETFs, spreads compressed again, and then most recently they've announced a desire to purchase individual bonds. So we would effectively expect those spreads to continue coming in as they target an easy financial conditions in the United States. Essentially, we've seen the similar type of story in Europe, but they've done it, we think, via the banks. And what we've seen is effectively the ECB has instructed banks to forego paying dividends and identified where the pain is going to be taken and where they're going to draw the line. And so we think that creates opportunities for implicit protection in places like high quality CoCos among European banks. If we look forward, we can also see to the next slide, going back to this idea of increased volatility, what we're seeing in 2020 is actually very similar to what we see coming out of the crisis in 2008, 2009. So this low volatility regime that we've gotten used to over the last few years will likely give way to a high volatility regime. While that is quite scary for people, what it does mean is we can tactically overlay protection within portfolios when volatility is cheap, and then realize that value as we get these volatility spikes moving through. So that's a very important tactical option. And as Peter has highlighted, one of the nice things about gold, look, the Federal Reserve, the ECB, the Bank of Japan have outlined their strategy. When they run into a problem, they're going to print lots of money. So the fact that money growth and gold are very correlated, they effectively give you that backstop. And so we think gold is now a very important foundation to this risk management structure going forward. Once we have that risk management structure in place, what that allows us to do in an uncertain world is then pivot to, okay, where are my opportunities? Where am I willing to take risk now? So we move to the next slide. One of the things as we talk to people, they say, oh, markets are very expensive from here. It's too late to get in. And indeed, when we look at valuations in the US, high equity valuations are there. The last time we've seen equity valuations here was in '99 and 2000, and that definitely wasn't the right time to buy. Indeed, for valuations to look even fair, you're going to need to see a historic rebound in earnings in 2021 from here. At this point, we think that's optimistic. So that is one of the reasons why, again, one wants to use a lot of protection within portfolios to guard against that. But it shouldn't prevent you from, on the next slide, digging deeper into the market to try and find opportunities. So one of the interesting things in the global economy today is you can see opportunities of how to deal with a slow growth, leverage balance sheet environment combined with high central bank liquidity, because we've seen two examples of that, first in Europe and then in Japan. And the lessons from both of those examples has been, one, you want to focus on quality. You can see the yellow bars in both. Being a quality investor just from a pure capital gains perspective has delivered you almost double the capital that being a value investor in markets has. In addition, in a low growth economy, you want to focus on growth. So economic growth is probably not going to do it for you. So you want companies that are gaining market share, driving margins to drive earnings. And again, very similarly, focusing on the yellow bars here, almost double the pace of capital gain that you see versus being a pure value investor. Why do I not focus on the green? You can see value. Being a value investor, you get more dividends. Most people like dividends. Income is very good. One of the challenges we see going forward, as Patrice has pointed out, leverage is very high in the system. Most companies want to pay down that leverage. And so rather paying dividends, rather than doing buybacks, rather than doing investments, we suspect they will go to pay debt. So we view some of those dividends at risk as we go forward, certainly the next 6 to 12 months. Beyond this value and quality focus that we encourage clients to have in portfolios, if we look to the next slide, again, transformation is going to be the key story going forward. I think we all like to think about, okay, work at home stories, etc. But we see transformation occurring across multiple axes around the world. And what this is going to require is that you take an active approach to investing rather than a passive or ETF approach to investing. So when we look and we highlight a number of them here, from an economic perspective, the transformation into a slower, more volatile period. In addition, corporates shifting from buybacks and dividends towards market share gains and pricing power. Households, this idea that Patrice has highlighted in terms of reshoring, shifting of household consumption patterns. These are going to shift the types of leaders and laggards within sectors. And then obviously, there are these long cycle stories, and we highlight 5 of them that we're focused on here to accelerate long cycle trend adoption. The way one should think about it is obviously coronavirus an important trigger, but a lot of these trends were already in place. The coronavirus is certainly an accelerator to these trends, and that's what we want to leverage. If we move to the next slide, if I just summarize where we are in terms of key messages, again, from Patrice, look for an unsynchronized recovery. But one of the keys is monetary policy is really designed to avert crisis, maintain these firewalls. And that allows us to risk manage. Why? Because the central banks have outlined how they're going to respond to averting these crises going forward. And what that means is we want to construct these safe haven portfolios via gold, via safe haven currencies, and then active risk management in the alternative space, also in the option space going forward. With that foundation, we can then step out and take calculated risk in places like equity and fixed income. On the equity side, we want to focus on quality growth, and then stock and theme selection are going to be key in transformational opportunity sets that we see around the world. On the bond side, where I know a lot of you are focused, again, look for two-way interest rate volatility here, but it's going to be, we expect, contained by Fed policy. As we've talked about over the course of the year, we want to take some of that volatility in credit markets, especially where implicit and explicit backstops exist from central banks. For us, that means in the investment grade space, in the European CoCo space, and the crossover high yield space. And as Peter has highlighted, again, one of the key themes on the FX side is going to be this dollar weakness story going forward.
Thank you, Norman. I would like to thank you for joining us today and our speakers for their insightful views. I hope that you found this web seminar useful, and we look forward to continuing to discussing with you. And if you have any additional questions, please do not hesitate to contact your relationship managers or send your question to investments@ubp.ch. Thanks a lot.